Hello, everyone. My name is Andreas Chrysostomou, and welcome to our second webinar for this week. It's our first Healthcare and Life Science Week, one of many, as we hope to establish this as an annual event for us. Together in the next hour or so, we will be covering a particular case study that goes through the biotechnology purchase accounting and related valuation. We will get a bit more into some of the complexities and intricacies of basically what we are facing when we're dealing with these issues. With that being said, I'm glad and honored that I'm joined today with three of my colleagues. First one is John Goldblatt, the Managing Director in our Healthcare and Life Science group. Next is Frank Deluca, a Director in our Healthcare and Life Science team. And last but not least, we have David Nadel, Director in the Healthcare and Life Science team, as well as he is part of our strategic value advisory business as well. With that in mind, maybe we should proceed with what we are expecting of covering today. Definitely the subject would be more on the purchase accounting valuation issues. That would be our focus, and how we dealt with some of the issues that or challenges that they're coming up with some of these more recent transactions that we are seeing in this space. Understanding, of course, the intricacies of the biotechnology valuation is very important, as you need to kind of navigate through the particular science involved and understand the actual value drivers that they basically resulted in the transaction. They need to have the transaction by the buyers. We are glad that myself, John, Frank, and David, we have been involved in numerous of these transactions, and we're able to kind of provide you as much of a background as possible. And by all means, I encourage you to use the Q&A function of the system and ask any questions. We will try to basically answer some of these questions as they are coming through, if they are relevant to a particular subject that we are covering. But at the same time, if we will leave some time at the end of the session to respond to those questions if we are not basically getting through during the course of our presentation. With that being said, let me kind of lay out the specifics of the transaction. And this is, basically an example that we are giving is not a particular transaction that we were involved. And a number, of course, of the transactions in the biotechnology space, they all look kind of similar. So in this particular case, AC Biopharmaceuticals, Inc. Has acquired an immuno-oncology company, JFD Therapeutics, Inc. As part of basically the transaction, in this example, we assume that the consideration was approximately $13 billion as an upfront. And of course, a common theme that we are seeing in some of the more recent transactions is the existence of contingent consideration. In this particular case, the amount that was presumed to be paid was $4.3 billion as a contingent consideration, but assuming that certain milestones are met. A few additional facts that you should have in mind is the fact that as of the transaction date, JFD's therapy, Chromap, had recently been approved as a third-line treatment for non-small cell lung cancer. This is a very important thing. We're talking about a few days before the transaction has closed, this event has taken place. And the reason why it is important is the fact that it does create a bit more of the complexities that we need to deal with as part of the purchase accounting and the related valuation. We recognize, and as part of basically the continuous development of the actual drug or therapy, I should say, it's the fact that the same exact therapy is being used and tested for a second line and a first line treatment of non-small lung cancer. The other facts, the same kind of treatment is being used for 3 different types of cancer tumors. The first one is melanoma. We assume the particular program is going to be in phase 3. Breast cancer, assumed to be in phase 2, and prostate cancer also in phase 2. At the same time, given that in this particular case, JFD is a relatively small company, as part of their own strategy before the transaction with the AZ Biopharmaceuticals, they out-licensed the Asian market to a partner, a collaboration partner. And it's something that basically existed as of the transaction date. These are the facts, and again, as we're going through with the details, John, Frank, and David, they will kind of be repeating some of these facts that we need to cover. What what does it mean in terms of basically the identifiable assets that we need to deal with? We are having, of course, basically inventory that exists, currently marketed products in relation with the approved Chrysostomou indication, and we have identified in-process research and development programs that they needed to be valued. And of course, we did consider the collaboration agreement that existed prior to the transaction with a third party for the Asian markets. At the same time, we looked into the valuation of the contingent consideration, something that, as I said earlier, is very common. On the offset, it looks kind of a straightforward exercise in terms of identifying these particular assets. But looking into the composition of these assets, we'll see that there are a number of complexities that they come up and we need to kind of deal with. The first complexity that exists in this particular case is inventory. As I said earlier, the Chrysostomou has been approved a few days before the closing of the transaction. As it is customary until that point, inventory that is being used as part of clinical trials is often being expensed by the companies. That being said, in this particular case, at the time of the transaction, the product has been approved. Therefore, the inventory that existed can be used to be sold directly to patients and therefore becomes an asset that needs to be accounted for. In discussions, of course, with management and their auditors, it needs to be understood how inventory should be properly accounted for, given the fact that when you look into the balance sheet of the company, you will not see an inventory balance because it's already been expensed. The second complexity that comes as part of the identifiable assets is the fact that we have the Chrysostomou being used for a second and first line treatment of the same type of cancer. As I said earlier, approved products, they are considered currently marketed, and from that perspective, they are capitalized and amortized going forward. The question that came up and the complexity, what do you do with the second or the first line treatments? When we look into the specifics, we realize that from a scientific standpoint, there was no difference on the actual treatment itself. It was just continuing with the clinical trials just to, as additional basically feedback for the, for the patient reaction in used as second or first line treatments. And therefore, we consider those being part of the currently marketed product that we evaluate. The third complexity that we dealt with in this particular case related to the other three tumors that they've been used, the drug is going to be used to treat. In those instances, because these are different types of tumors, different targeted populations, the decision that was made is to treat those as still in development R&D programs. And that's basically how we proceeded. Last but not least, is basically in terms of the requirements on how you approach the valuation. In this particular case, we were able to kind of identify the specifics for each of the population, of the patient population that we will be treating. This is, in summary, what we will be covering in more details and getting into the numbers and to explain how the evaluation is being done. With that being said, John, take the lead.
Sure. Thanks so much, Andreas, and hi, everyone, and thanks for joining. So I'm going to start getting into the details here to cover sort of the more specifics of some of the conceptual complexities that Andreas took us through. So to get us started off, we'll talk about inventory valuation. So as Andreas mentioned, JFD had previously expensed inventory related to clinical trials that is now saleable since Crolomab has been approved for that third-line non-small cell lung cancer indication. As Andreas mentioned, the decision was made after consultation with AC and also with their auditors to bring that expensed inventory back onto the books. So in this case, the finished goods balance as of the valuation date was $10 million. From an actual sort of valuation methodology perspective, what is most typically used and sort of best practice is a net realizable value method, which is based on the selling price of the inventory less cost of disposal and also a reasonable profit allowance on that disposal effort. The application of the net realizable value was based on several key assumptions, and we'll go into some of those on the next couple of slides here. Per our discussions with AC management, the existing inventory was related to that improved indication, again, non-small cell lung cancer. So the question that sort of arose was, okay, well, what financials should we be looking at to help establish that net realizable value? The decision was made, again, based on the facts, to look at that next year's financial projection for the non-small cell lung cancer indication. And you can see sort of a snapshot of what that first year was to look like. So the next step in the inventory valuation is really to split those financial projections between incurred activities versus remaining activities. So what do we mean by that? So incurred activities is really activity that's sort of already embedded in the inventory versus remaining, which is more related to disposal. And you can see the split of the various costs and the revenue. So on the left-hand side, you'll see what we call inventory attributes, which is the cost of goods sold, an allocation of G&A, and an allocation of depreciation. On the right-hand side, you have the disposal attributes, which is, of course, the sale of the inventory itself, selling and marketing, in this case, research and development, or at least a normalized level of research and development, and then again, an allocation of G&A and depreciation. The next step is what we refer to as sort of profit attribution, right? So if we go back to the 2 slides ago, we had seen sort of the full profit margin for the non-small cell lung cancer indication for the first year. So now the question is, how much of that profit is baked into the inventory already, right, as part of the finished goods versus what is left to be earned, if you will. So a very important point with respect to biotech valuation is the typically, that big intangible asset profit that you think about. So that's really your patent and other intangible type assets for a particular product. The typical assumption is that it is baked into the manufacturing process. And you can see on the left-hand side there, we have a very large sort of implied intangible asset royalty baked into the inventory. So basically what this slide is attempting to demonstrate is, really the profit that's left for that disposal activity is relatively minimal when compared to how much profit's been earned with respect to the manufacturing effort. So ultimately what that means, to sort of cut to the chase, is in most cases, you'll see relatively large inventory step-ups in this industry, just generally speaking. Certainly not the case across the board, but that is, I would say, most common. And what we are demonstrating here is both a top-down and bottom-up approach. So in this case, we had $10 million of carrying value finished goods, and we arrive at a fair value of about $75 million. One other thing to note here is that in cases where you might have, a relatively large inventory balance that's going to be run through over a long period, it is customary to include a holding cost adjustment to the fair value. We have not included that in this particular example, but that is something that I would say another complexity that we have to wrestle with and consider as we're valuing inventory.
John, maybe one additional point here. As we pointed out in this particular case, the fact that inventory was expense, the first step as part of the process is actually to come up with what would have been the book value of the inventory if it was to be capitalized in the normal course of a business. So the actual step up is almost getting it from zero to what would have been an appropriate book value of capitalized inventory before we proceed into the true fair value of that inventory, in the normal course of an inventory valuation.
Yes. So moving on to the currently marketed product valuation. So again, just a quick refresher on the facts here. So Crolomab has been approved as a third-line treatment for non-small cell lung cancer. And as of our valuation date, was in clinical trials as a second-line and first-line treatment. So again, after talking with AC management and their auditors, the decision was made that cash flows related to the second and first lines of treatment for Crolomab would be combined with third line in order to value the currently marketed product asset. And you'll see sort of an interesting dynamic on the next couple of slides here with respect to probability of success, but we'll get to that in a second. The fair value of a currently marketed product asset was established via the multi-period excess earnings method, which is a form of the income approach. So the two main, let's say, general pieces of that analysis are really the financial projections for the asset in question, and then the selection of an appropriate discount rate. So as you might expect, based on the facts here, the revenue projections for Crolomab for the treatment of non-small cell lung cancer capture the entire life cycle of the product. With respect to the revenues for the second line and first lines of treatment, because they're still in development, there is a probability of success, probability of regulatory/technical success adjustment that's embedded in the projections themselves. And you can see that demonstrated on this slide here. The first, say, 4 years, we're at 100%, and then you have probability of success adjustments for second line and first line treatment as we go. The other thing to comment in here is there's an assumption that there's different geographies baked in here. So that's why you see some of the probability numbers sort of fluxing as we go forward. With respect to cost of goods sold, selling and marketing, general administrative expenses, management was able to provide us information at both the indication level or the tumor type level, as well as by the different lines of treatment. With respect to research and development, I think the important point here is one of the questions that we asked in this particular case, and that the auditors will certainly be looking for, is ensuring that the R&D baked into this particular asset, that with respect to second line and first line, that appropriate probability adjustments are baked into the R&D projection, and that was certainly the case here as well. One important thing to note that we, again, just for simplicity's sake, didn't model per se in this particular example, is that R&D incurred in the U.S. is subject to capitalization and amortization starting in 2022 in accordance with the 2017 Tax Cuts and Jobs Act. Obviously, we know that the taxes are a big topic of discussion in Washington these days, so we'll see if it's affected at all by whatever might come out of it, but that is the rule right now. With respect to tax rate, in this particular case, we used a 21% rate, which was based on the anticipated blended tax rate for the currently marketed product, which is driven by IP ownership jurisdiction, which in this example is assumed to be in the U.S., commercialization jurisdictions, et cetera. In this particular case, the discount rate of 7% was based on the internal rate of return for the transaction. The last step in the analysis, again, somewhat simplified, but is the application of a tax amortization benefit to that excess earnings. So in this case, the IP was owned or assumed to be owned in the United States, so the U.S. rules apply. So a 15-year amortization period, a 21% tax rate, and a 7% discount rate. Maybe just one other comment here. This is something that we wrestle with quite often in our valuations as well, is really honing in on what the correct treatment is for the tax amortization benefit. So if you have IP that's owned in Ireland or Singapore or some other jurisdiction, it is certainly key to be aware of what the rules are for amortization in those jurisdictions so that you capture it appropriately. So at the very bottom, we have sort of the outcome of the analysis. So the sum of the present value of excess earnings in this case was about $3.7 billion. We deduct the tax-affected inventory step-up. So the dynamic here is that for that brief period where you're running off the inventory that's been stepped up, your cost of goods sold is actually a bit higher. So there's sort of a push and pull there between the inventory valuation and the currently marketed product valuation. And then again, we add on the tax savings due to amortization to arrive at a value of about $4.2 billion. Mm-hmm. Okay. So with that, I'll turn it over to Frank to cover the IPRD portion of the discussion.
Thanks, John. With regards to the in-process research and development in place and currently being developed by JFD at the time of the transaction, as Andreas mentioned in the introduction here, the company was currently developing the crolumab treatment for 3 additional tumor types that were not yet approved: melanoma, which was in phase 3 at the time of the transaction; breast cancer, which was phase 2; and prostate cancer, which was also in phase 2. As Andreas also mentioned earlier, after discussing with AC Management and their auditors, we determined that each tumor type constitutes a separate IPRD project, since it requires separate clinical trials and regulatory approval. However, the different lines of treatment within each tumor type are assumed to be part of the same IPRD project. And therefore, at the end of the day, we have 3 units of account from an IPRD perspective. Like the CMP, the fair value of the IPRD projects was established using the multi-period excess earnings method, or the MPEM, or excess earnings for short. The revenue projections for each tumor type were projected similar to the CMP across the entire life cycle of the product, going from initial launch and ramp up through patent expiry at the end of the projection period. The various the projections we received were by tumor type, but also by line of treatment. So whether it be first line, second line, or third line. And similar to the CMP, you can see here that the implied probability of success on a combined basis by tumor type does fluctuate as different geographies and different lines of treatment are launched. One intricacy here that you may see and notice on the breast cancer tumor type here is that the probability of success actually increases a little bit, and that's because in this particular instance, some of the lines of treatment actually had and geographies actually had some higher probability, but they launched a little bit later, which caused actually some POS increases as you go through the projection period. These are used as the basis. These revenue projections and P&L projections are used as the basis for our excess earnings valuation for each of the IPRD assets. The projected cost of goods sold, selling and marketing, and G&A expenses were also provided by tumor type, and then they were subsequently a POS adjusted for the probability of launch based on the projections for each of the tumor types. From an R&D perspective, understanding that R&D is still ongoing for these IPRD assets as they're reaching or attempting to be launched and approved, we received R&D expenses by tumor type and by line of treatment. I think the important thing to note here on the R&D is that when we apply the R&D in the model, we POS adjust the R&D by phase of development. So the R&D currently being spent on the existing or the current phase for the asset. So for melanoma, all the phase 3 R&D spend, that's going to be at 100%, and that's going to just be at what's expected to be spent for breast cancer and prostate cancer, that phase 2 spend. But as the asset moves through the path of development, the phase 3 spend for breast cancer would then be adjusted by the probability of getting from phase 2 to phase 3, and then any post-approval R&D required, any maintenance R&D or post-phase 4 studies, et cetera, would be adjusted by the probability of launching the product. Tax rate of 21% was used in for the IPRD assets, again based on the tax rate for the specific assets, the jurisdiction where the IP is owned, and where the product will be ultimately commercialized from a jurisdiction perspective globally, and a discount rate consistent with the discount rate of the overall transaction was used. Like the CMP, we also layer in a tax amortization benefit. Again, like the currently marketed crolumab, these IPRD assets, IP is owned in the U.S., so we did use U.S. assumptions. And at the end of the day, we get to a value of about $7 billion for the melanoma IPRD asset, $830 million for the breast cancer, and about $4.7 billion for prostate cancer, after combining both the present value of the excess earnings and the tax amortization benefit. The last intangible asset that we valued as part of the transaction was the collaboration contract that JFT has with a collaboration partner for the Asian markets. It's more just a little bit about the agreement. So the agreement's for all tumor types and all lines of treatment. So we included revenues associated with both the CMP, its lines of treatment, as well as the IPRD assets and their lines of treatment as well. The agreement is structured as a variety of sales milestones and royalties. Sales milestones of $25 million, $50 million, and $100 million are based on achieving certain levels of annual sales. Important to note that these milestones are hit once. And then the royalties range from 10 to 16% in a tiered structure based on level of sales. So 10% for anything under $250 million of aggregate sales, $16 million for sales above $1 billion, and then the tiers in between for 12 and 14. based on discussions with AC management and their auditors, we value the collaboration agreement as a contractual asset and projected out the cash flows associated with this contract over the life of the products and utilize the income approach as the basis of the valuation. And again, this income approach is predicated on the projected sales of Crolomab and what that means in terms of cash flows coming out of the collaboration agreement. As I just mentioned, we use the revenue projections for the products to forecast the cash flows that come out of the agreement. The important thing to note here is that when you're developing these projections for the agreement, it's important to do everything on a pre-POS adjusted basis. As you can imagine, once you layer in POS adjustments into the revenue, you can drastically affect the level of revenues, and that could change what royalty tier you assume and what sales milestones you hit. So the important thing here is when we structure the models, we do the calculations on a pre-POS adjusted basis, and then POS adjust the resulting cash flows based on the blended probability of the tumor types and lines of treatment that are included in each year. So in this case, we're projecting just hitting to the second tier of the royalties, but we do hit all the sales milestones eventually. We used, again, 21% tax rate, 7% discount rate, and layered in tax amortization benefit, again, with the IP being owned in the US. At the end of the day, discounting back the cash flows from the agreement, we get to an estimated value of approximately $170 million for this contract. That wraps up the intangible asset side. Now on the liability side, David will talk us through the contingent consideration of the deal.
All right, thanks, Frank. So it's been it's been nearly 15 years now since the accounting guidance related to business combinations changed and now require contingent consideration to be measured at fair value at the time of acquisition, and generally requires remeasurement at every future reporting period. In this example today, we've got a very common structure seen in the biopharma for biopharma transactions, namely a regulatory milestone of $1.25 billion upon FDA approval of Crolomab for either melanoma or prostate cancer, and then a sales milestone of $3 billion when the annual net sales of Crolomab exceed $1 billion. So, as noted in the guidance for valuing contingent consideration, a probabilistic model is generally required to value these structures. And we typically see two options employed: scenario-based models and option pricing models. Scenario-based models are used when the risk associated with the underlying is diversifiable. That means not correlated with the market. And the simple example here is, of course, a regulatory milestone, such as FDA approval. And the scenario model can sometimes be as simple as just looking at two cases. You either succeed or you don't succeed. And each of these cases has a probability. And the math can be fairly straightforward. However, it's the support for this probability that really ends up being the heart of the analysis. The second group of models are the option pricing models. And these are needed when the metric risk is non-diversifiable. That means correlated with the market and the payoff structure is nonlinear. So what does that mean? So business performance metrics such as revenue, EBITDA, net sales, those fall into the category of metrics that are non-diversifiable. And nonlinear payoff structures simply means that there's threshold caps and tiers. And in this case, we have a sales milestone. There's a threshold. You hit the sales, you get the payment. Below that, there's no payment. So in our example today, we'll use the scenario-based model for the regulatory milestone and an option pricing model for the sales milestone. So before we jump into the valuation of each of these milestones, first we're going to look at kind of the key assumptions here, the discount rate. So this is probably the assumption that gets the most discussion in contingent consideration valuations. The discount rate used in the valuation of the business, typically the WACC or the IRR, that Frank and John have been talking about, is appropriate for the long-term free cash flows of the business. Contingent consideration cash flows typically have a much shorter time horizon, and the metrics that contingent consideration is based on, such as revenue, are less risky than the cash flows of the business. Therefore, typically, the discount rate we used in the valuation of contingent consideration is lower than the rates used in the overall business valuations. However, there are key assumptions that pieces that go into building up the discount rates that need to be consistent between the two. And the final point is that counterparty risk must be considered as well. And this essentially means that we're capturing the risk that the buyer fails to pay the milestones when they're achieved. So first, we're going to look at the valuation of the regulatory milestone. So the regulatory milestone is earned upon approval by the FDA for the treatment of either melanoma or prostate cancer. That means in this case, we have two different possible paths that can lead to achievement of the milestone, and we need to consider both options as illustrated here. Since melanoma is currently ahead of prostate cancer, we'll first consider the probability and timing of achieving the milestone upon approval of melanoma, and that's scenario one. Melanoma gets approved, you get the milestone in about 2 years. The second scenario comes into play when melanoma is not approved. In this case, the milestone gets triggered by approval for prostate cancer. And of course, we have a final scenario here where no milestone is earned. And we note that, as John and Frank were talking about, there are other indications in development. However, the language of this contract was specific for these milestones being tied to these two tumor types. This isn't unusual. We often see that certain indications are carved out either because of interest of the buyer or the seller on tying milestones to those programs. So once we've estimated the payment in each of these outcomes, we present value the payments for each outcome based on the expected time to payment and a discount rate that captures both the time value of money and the counterparty credit risk. And this typically ends up being a cost of debt. So now let's move over to using the option pricing model to value the sales milestone. In the first step in using an option pricing model is we need to take the expected sales forecast and transform it into a risk-neutral forecast. And this is to transform the forecast into a forecast that we can use in the option pricing world, which operates in sort of a risk-neutral framework. And we do this transformation by discounting the forecast. So instead of discounting cash flows that come out of the model, like in a DCF, we're discounting the actual forecast. And mechanically, what we're actually doing in most cases is discounting the growth rate. And that's what's shown on the chart here. You have your expected forecast, and then you're discounting it to the risk-neutral forecast. We often implement the option pricing model via a Monte Carlo simulation, which generates many possible upside and downside scenarios for sales. The first chart here shows 10 such simulation trials. And you'll note that the spread, how much between the different trials gets wider as you go further out in time. That's because there's more uncertainty in what projections are going to be like in years 7, 8, and 9 than there are in years 1 and 2. This simulation allows us to estimate both if a milestone is achieved and when the milestone is achieved. In the second graph here, we're highlighting the 3 paths from the simulated trials where the $1 billion sales threshold is achieved. And finally, we simply average the milestone payments across all the different simulation trials and discount to get to fair value. And in the example we're going through today, our simulation needs to take into account the likelihood that each of these follow-on indications that are still in development actually launch. So in any given trial in the simulation, we will always have that first indication that's already been approved and launched. But on certain trials, we'll have the prostate cancer indication. Certain trials will have the melanoma. Certain trials will have both of them, and certain trials will, all these go into the play in determining whether or not a sales milestone is achieved on a given path. And so the output of the simulation, as I mentioned, is the probability of hitting the milestone in each year, along with the expected payment in that year. Since in the first step of the analysis, we transform the revenue projections into a risk-neutral framework, these are risk-neutral probabilities and risk-neutral expected payments. And so consequently, the discount rate that we apply to these expected payments is simply the risk-free rate plus again, that premium for counterparty credit risk. And again, this in practice often becomes a cost of debt. Because we don't want to forget, we've already applied one discount rate directly to the projections. So we don't need to do a WACC-like or an IRR-like discount rate here. We've already done that step. And then the final step, in the contingent consideration valuation is really now to assure that our assumptions are aligned with the overall PPA analysis. And often we find that we need to kind of iterate with the calculation and estimation of the IRR, because as we get a contingent consideration value, that changes what the purchase price is that you're using to solve for your IRR. Once you resolve your IRR, you've changed your IRR, and that's going to affect the discount rates in the contingent consideration. So we have this iteration at the end once we've got all our pieces to get everything to align to kind of conclude on both what the transaction price ultimately is and what the fair value of the contingent consideration is and what the IRR is. With that, I guess open it up for questions.
Sure. Thanks, David. It doesn't look like we have any in the Q&A at the moment, but maybe I have a couple of other points that I think we can bring up, or a question that I can ask. So, understanding that we were all involved in this particular hypothetical project, but what do we think was maybe the biggest sticking point for the auditors, or let's say the complexity that required the most, let's say, hand-holding and guidance to get them comfortable?
An interesting question, John, and definitely the first question that they always ask is the identifiable assets and the basis of which that is being performed. We should say that at the end of the day, the identification and recognition of those assets, it is an accounting question more than a valuation. But that being said, the valuation questions that we usually ask, what are the value drivers and how basically the future cash flows are generated, do help in answering those questions and fitting them in. So at least in my view, that was one of the areas that we had a good discussions with the auditors, and management needed to kind of basically support the identification of the assets currently marketed product versus IPRD programs that they recognize. And I don't know if anybody else has a different view, but by all means.
Yep. I think the other sticking point here, or area of questioning that comes up in these situations is getting to the right starting point for the inventory. Understanding that the inventory on the books or in existence as of the valuation date was partially expensed through the R&D process. So having to go back through the various lots that are in there and recreating a cost to manufacture or existing book value to get back on the books and start the inventory analysis is one that requires work with the client, and also a lot of support in getting it through the auditors as well.
Maybe one additional question, and I don't know, John, and maybe Frank and David, it's how do we go about establishing an appropriate discount rate for the different assets? And I don't know, John, you would like to kind of maybe comment on that. So,
sure. Yeah, absolutely. So, in this case, like other cases, there are two sort of main places that we start. One is the weighted average cost of capital, right? So we can look into other market participants and run a weighted average cost of capital analysis and see, what kind of indication we get from that perspective. In this particular example, and as part of the other work we do in that area, is running an internal rate of return calculation on the transaction itself, right? So really equating those probability adjusted cash flows to the purchase price, which in this case is comprised of an upfront payment of $13 billion, and then plus the fair value of that contingent consideration that David and team did. In instances where we have a weighted average cost of capital that is relatively close to an internal rate of return indication, that generally makes us and auditors, comfortable without much additional questioning. If those deviate significantly, there are always those additional questions to answer. It's like, okay, is there something in the projections that's overly aggressive? Is there somehow a bargain purchase that's involved here, right? Were the facts and circumstances surrounding the transaction such that, in this example, JFD had to sell or something along those lines? Again, what wasn't the case in this example, but that is a question that sometimes comes up. So it's a long-winded way of saying that, we have to look at a WACC, we have to look at an internal rate of return. Those are often the basis for the intangible asset discount rates. But substantiating any differences that we see is certainly a key part of that process.
And with respect to the contingent consideration discount rates, we're starting with those same IRR and WACC, except we have to consider that the metrics that what we're applying that discount rate to is different than the cash flows of the business. Mm-hmm. So in the example here, we'll start with the WACC, that John and Frank have built up. That involves, if we're using like a CAPM model, it has an equity beta in it. However, we're applying, the discount rate to revenues. So instead of using an equity beta, we need to estimate a revenue beta. So to do that, we're essentially using the same methodology used to estimate an equity beta. We're looking at comps, we're looking at correlation with the market over time. And then our other parameters that we go to build up our discount rate, such as small stock premiums, and so forth, and alphas, those are what tie back to the WACC, and that need to be consistent. Again, the entire small stock premium is applied again to the cash flows of the business as a whole. That whole premium may not be applicable to revenue, and that's a judgment that needs to be made. But you need to you have to link the two, because the whole valuation has to hold together.
Yeah. And maybe going back to the original question as well, in terms of the pitfalls or the questions that the auditors have, if you do notice that the values that come out of the analysis, it essentially assumes zero goodwill from an overall perspective. And in this situation, we have all of the projected cash flows for the business are in existing assets or in identified assets. So the existence of no goodwill or even slightly negative goodwill after you layer in after you layer in the various methodologies is something that's not necessarily surprising to us, but definitely a conversation that we have with the auditors in every single asset transaction, which this essentially is, right? You have Curlmab that's approved and in development for various tumor types, which is essentially a single asset. For those single asset business combinations, it's definitely a conversation that's had every time.
Yeah, that's right. And maybe David, going back to your application of appropriate discount rates for continued consideration valuation, in your session, you kind of distinguish between development milestones and sales milestones. And you pointed out that development milestones was basically a much lower discount rate versus sales or performance milestones. Can you maybe elaborate on that in the distinction of the discount rate and the reason why you do that?
Sure. So with a regulatory or a technical milestone, essentially the probability that we're applying for achievement is in essence is capturing all the risk. So the only risk that's not captured, is going to first be, that time value of money. So it becomes the risk-free rate is the discount rate. It's the sales and technical and regulatory milestones are seen as diversifiable. We do have to then apply that counterparty credit risk on top of it, because that risk isn't captured in the probability. So that's why it becomes a cost of debt rather than a pure risk-free rate. If you actually stuck the payment amount in escrow, then we would discount it at the risk-free rate, although most people don't want to have, in this case, $1.25 billion sitting in escrow indefinitely. with the sales milestones, we're looking at business performance metrics. So we have the non-diversifiable risk, and that's where we need to essentially we're looking at, again, kind of a WACC-like discount rate built up a bit differently with a couple different, we use some different terminology, but that in essence was what it is. And so there's that risk that doesn't get, that's not otherwise captured, and that's what we're capturing with that discount rate, and that's why it tends to be higher. One interesting note that does come up is when you have buyers who are particularly low credit worthy, you can get some really high discount rates when you have like CCC rated companies, because there's a high risk that they're going to default on that obligation. So we do occasionally see, extremely high discount rates on regulatory milestones because of that fact pattern. We've actually seen companies that have, had milestones they owed, but aren't able to pay. And that leads to lots of discussions about what the next steps are between the various parties, often renegotiating deals and extending terms and so forth. But that risk is what's being captured in that cost of debt and why it's important.
Yeah, it's a good point, David, and definitely I think you kind of pointed out it is an obligation. The one challenge that we often have when we describe to our clients the selection of the discount rates for contingent consideration is the fact that we need to recognize this is an obligation of the buyer at the end of the day, and we basically consider it as such in selecting an appropriate discount rate. It's how the buyer would perform going forward to meet these milestones, because in essence, it's a in quotes a loan from the seller until those milestones are met. So, good point. Anyway, any other points that basically you guys would like? I think there is a question on the Q&A that maybe we can touch on. But anything else, John or Frank or David, that you want to add on?
I don't think so on the points that we've just discussed. Andreas, if you'd like, I can read the question aloud, and we can all chime in here.
Yeah, please go ahead, John.
Okay. So the question is, what are some common pitfalls to watch for in an equity method investment structured like this versus an acquisition? So I think the crux of the question is, similar structure where you have upfronts, milestones, collaborations, et cetera, but an equity method investment versus an actual business combination.
Yeah, an interesting question, and definitely it comes with its challenge, right? I believe there is the first thing that we need to kind of distinguish. This is more of an accounting than evaluation first, right? Accounting question than evaluation first. Definitely, equity method investments, they are accounted for differently. And you're not necessarily kind of fully consolidating unless if you're going to obtain kind of control. So in terms of actual valuation, the approaches that we will be taking in valuing the underlying businesses first is going to be the same. Same expected cash flows. And at the same time, if we are looking into valuing the specific assets, so you can create the separate balance sheet that you need to properly account for equity accounting, we won't want to do anything different in valuing the specific assets. Again, IPRD programs would be valued based on multi-period excess earnings. Currently marketed products would be valued in a similar way. The identification of those assets would be also valued in such a way. So at least that's kind of my view. And I don't know, John, Frank, or David, if you guys would like to maybe add to that as well.
No, I agree, Andreas. I mean, I think at the end of the day, from a pure sort of valuation perspective, the approach to the underlying assets would be the same, and in order to arrive at any value indication. I think what we presented here is certainly a best practice, not only for a business combination situation, but really the valuation of any asset or business in sort of the biotech space.
And again, I don't know basically the treatment of milestones. Again, in an equity investments, it seems like you may be increasing your investment down the line or increasing your ownership depending on how you structure the deal. But again, to give a bit more clear answer as to other common pitfalls, we will need to kind of see more specific as to how the actual transaction is being structured, even if it's an equity investment. So at least that's kind of my thought process as part of this. Happy to basically separate, reach out, and maybe get a bit more background if there's a particular transaction that you have in mind. And I'm referring to the individual who raised the question, so we're able to kind of respond in a more clear or direct way. I know that we are almost coming up to the hour. Maybe a question for you, Frank, in relation to the IPRD programs that we consider valuing. We definitely look into probability adjusting the cash flows. How do we balance between adjusting the cash flows and adjusting discount rate selection? Any thoughts and anything that you can share with the audience?
Right, absolutely. Well, I think the important thing to note is kind of goes back a little bit to John's point earlier on the internal rate of return. When we calculate the internal rate of return, we are using fully probability adjusted cash flows, right? So the discount rate that we're calculating compared to the purchase price and the cash flows is on a post adjusted basis. Now, when we think about individual assets, the question is, should certain assets have an additional premium over and above the IRR? Again, when we think about the probability adjustments, we are taking a lot of that risk in the development process into account in the cash flows. So we don't want to necessarily increase the discount rate just because it's an IPR&D asset or just because it's in development. You really want to take a look at the facts and circumstances. In this case, and what we see in a lot of biotech businesses, the vast majority, if not all, the assets are in the identified intangible assets. So if you're thinking about the value of the overall business and the value of the assets, in most cases it does become one and the same, because you don't really have that large hierarchy of returns that you would maybe see in some other businesses where you have a lot of fixed assets at a lower return, and then you have the intangible assets that should be higher than an average to the overall business. So in the case of businesses like these, where most of the value is in the intangible assets, we really do use the IRR as a starting point, because we've already diversified a lot of that risk out in the cash flows with the probability assessments.
Good, great. Thanks for the feedback and background. It seems like we don't have any other questions, and we are up basically right on time for our session. I would like to thank everybody who basically joined the session, our audience. But Pavel, I would like to thank John, Frank, and David for basically walking us through the actual case that we went through. And if there are other questions, by all means, please reach out to us. Happy to engage on a one-to-one basis and provide more responses to your questions. Thank you again.
Thank you.
Thanks all.